with real estate or really any business, you can create something out of thin air based on what suits you. And it's going to take you a while to get to maybe your ideal state to wherever you want to go.
Right?
But just know that just keep on working at it and you can carve out whatever niche is appropriate for you that you want as long as you just keep taking action and you just keep getting up, because you're going to get knocked over quite a bit. But that's all part of the process.
Yeah, man. Don't quit and don't die.
Don't quit. Yeah, you can only lose if you stop.
No, 100%, man. Well, go on, you multifamily enthusiasts. Welcome to another episode of the Multifamily Real Estate Experiment podcast. I'm your host, Shelon Hutchinson. If you're in real estate, you know me as Hutch the Marine Investor. And look, today we have an exciting guest for you. See, most of us, we hear this thing about Main Street and Wall Street and a whole bunch of ABC Street and 1-2 Street, all those things, right? And you tend to hear those things as one or the other. So today we want to capture someone who have experienced both worlds, right? So I'm excited to welcome someone that bridged four generations of real estate wisdom with next gen private equity innovation. Michael Pouliot is a CFA and a CAIA. He's the founder and CEO of Eon Capital Partners and the chief investment officer of Carbon. It's a middle market private equity firm. So with over $1 billion in real estate acquisition and over 1 million square feet of office and mixed use project on his belt, and $400 million plus in housing related transaction, Michael brings some serious institutional expertise to this space. He's also the host of the Deal Flow podcast, and he's a super passionate advocate for educating the next wave of real estate entrepreneurs. So Michael, I want to welcome you to this episode of the M3 podcast.
Thank you, Hutch, for having me. I'm excited about this podcast. Yeah,
Man, I am too, man. So it sounds like you got a busy morning, but you choose to be here, man. So we really
absolutely.
appreciate
Yeah,
it.
yeah. Can't miss out on a podcast opportunity. Yeah, I
Man.
love getting on podcasts.
Yeah, so Michael, I want to ask you this first question though. Do you have a favorite real estate quote or philosophy or mantra that drives you?
I don't know if I have a specific quote that I could say off the top of my head that I wouldn't butcher. But I would say, a philosophy or a mantra would be margin of safety, which is a Benjamin Graham and philosophy, and then that was kind of taken by Warren Buffett. And I think it's something that a lot of people think about, but margin of safety when you're buying real estate and you're dealing in real assets, margin of safety is really important, whether that's about having good reserves, about buying at the right price, about capitalizing your deals appropriately with the right type of debt. So margin of safety is really important concept, and I think if you kind of apply that in your acquisitions and in your management, you can weather a lot of storms.
Absolutely, man. That goes for the passive investors as well, right? One of the things
Mhm.
that I typically talk to them about is their risk tolerance and their risk capacity. To us that's really important. Okay, so margin of safety. All right, man. I appreciate that. So now I want to dive right into it, man. And I want to ask you, look, Michael, you are a fourth generation real estate entrepreneur. Right? What was it like growing up on the job site, and how did that shape the way you operate today, especially now that you work with on small projects, $25,000, to really large project, $25 million deals.
Sure. Yeah. Thanks for that question. So, yeah, I started being familiar with real estate as a, kind of a day laborer. And I would, work on my father's job sites. My grandfather would pick me up early in the morning when it was still dark, and we would go pick up a couple other folks that were working, day shifts basically, and I would be part of that crew, essentially digging holes and leveling ground and laying down, plumbing and going and grabbing and gophering around, like getting toilets and stuff from commercial outfits. And, I spent my summers and my holidays doing that. It was great pay, great cash pay at that time compared to what I could get from a store, which, at a store or something, I maybe make $4 or $5 an hour. But doing this, I can make, 15, $20 an hour. So for me, that was fantastic. Um, and, um, and yeah, I think what I learned from that experience was probably that I didn't necessarily love that part of the business of being on the site and kind of being part of like the ground game. And that's, from that experience, really learned that I had more of a knack for and a more of an appetite or interest in more of the financial side of these transactions, and really thinking about hiring the right people to go and do these projects and executing them with a fine attention to detail. It's more of a big picture type of thinker. And so I was really thinking about how to put these projects together, and then how to find people who are more engineers, more, detail oriented to actually execute the construction, the project management, and things like that. Obviously, it took time to get to that point, but those are a couple things that I learned from, long days on the job site.
So
Uh,
that is amazing journey, man. Like, planting the seed for something beautiful to grow. So you got involved, with the construction aspect of real estate, but also you saw a really bigger picture that you can add a ton of value. And that kind of brought you to more so of the financial world that a lot of people know, man. So you spent some time, on JP Morgan, fixed income trading desk, and consulted for some big heavy hitters like Goldman Sachs and Merrill, right? So what specific lessons from Wall Street still influence how you structure your deals and leads in today's environment?
Yeah. So I had that early experience, and then I went and then got my undergrad in finance in Boston, and then was it was I don't know, it was kind of before software engineering became like this, maybe the sexy thing to do, and it was still in this world, and at least for me, and growing up in the Northeast, that like finance or law or were kind of like the things to do. At least that was what was attractive to me. And so I went into finance, and worked on Wall Street for mostly in fixed income, working with ultra high net worth individuals to build their portfolios and help them manage their money, mostly for JP Morgan. And the things that I learned from my Wall Street career were primarily about a couple things. So I had a number of really great bosses. I don't know that I recognized them as great bosses at the time, but now looking back, I feel like I learned a lot from them. I think there's a difference. I don't know if I would call them my friends, but I learned a lot of lessons from them. And some of those, one of them in particular, was having like an intense level of paranoia relative to your work product. And so we had this sort of two-strike rule at JP Morgan that, if you made one mistake in a client meeting, you'd get a warning. Your second mistake in a client meeting, you would be fired. And so, that level of standard is something that we try to instill in, our teams. It's a little harder now to do that with folks. It seems, but we were held to an extremely high standard, very high stress environment, and just making sure that everything that we did, there was a maker checker system to it, that nothing went to a client without being thoroughly reviewed. Because at the end of the day, that if it's your draft, you're the one that's responsible for it. And so that, whether that's an Excel model or a PowerPoint presentation or a memo of some kind, or even just a statement that you make, that's your draft, that's your words, and that's important. And then the second thing I would say was around just recognizing, most of these days that I had were, 14-hour days. Where I was working, getting in early before the trading, before the traders. So I would be in at 7, and then staying till 7 or 8. But then I had a 2-hour commute on either side of my day. So it was a pretty long day. And sometimes that 7 o'clock at night became midnight, and that was, definitely frequent. But what I learned from that was anything can pretty much be accomplished in one day, no matter how long that day is. Especially when you're working with computers and you're putting together, a memo or a presentation or something like that that's in your control, that's right in front of you. There's really no excuse to leave the office or leave that work until it's done. And so And that was just like a requirement. So we would get assignments in the middle of the day, and they had to get completed by the time we left because they were due by the time we got in the next morning. So whether you had to stay till 8 to get it done or 8 a.m. the next morning, you just had to get it done. So the confidence that I think that develops in someone is really important, recognizing that no matter how big the work effort is, almost anything, especially if it's in your control, if it's just a work product on your computer, it can be accomplished in the day that you get it started. And I think that gives you a lot of confidence to be able to go out there and, get an enormous amount of work completed if necessary in a short period of time. Yeah.
Man, that is an amazing point of view because I think a lot of us, we always think about we can do that tomorrow, 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 and tomorrow never come. But to your point, I've seen a lot too, even in my own experience, right? Where if I have a timeline, so if the boss tells me, as a young Marine growing up, the boss tell me I got this report or I have this award to write up and I have like 3 weeks to do it. It will get done in 3 weeks, right? However, that same award, if you tell me that need to be done by the close of business today, that will be done by close of business today. So, and the same is true about the goals that we establish for ourselves, those things that we want, the incremental things we want to accomplish. If we set it that we will get this done in this timeline, this timeline, this timeline, and okay, what if we shrink that timeline and we can actually expedite our goals and we can actually put our life on a faster trajectory? You know what I mean? So and we were talking about, me submitting my retirement paperwork, for 18 months from now. And, I got 18 months to retire. But however, what if I shrink that, right? And all the things that I need to accomplish, I get it done within 6 months, so the next year can be really focused on that transition portion, So yeah, to your point, man, we can get a lot of stuff done as long as we set short deadlines. All right. So I want to talk about some of the investment philosophy in deals, man. So with hands-on experience in everything from single family home, to millions of square feet in office development, how do you personally evaluate opportunities that you're pursuing in today's market?
Yeah. So primarily now at this point we focus on housing.
Okay,
So we really think about housing and primarily that's workforce housing. So we're not doing while I've worked on a lot of spec luxury homes that are millions of dollars individually right now and for the last bit of time, at least the last 5 years, really been focused on workforce housing and whether that be single family or apartments, but in
gotcha.
that space, in primarily growing markets throughout the United States. So if I think about what our philosophy is or how we think about making investments in that space, it starts with the area. So it definitely starts with we're looking at the demographics of the area, we're looking at the schools, we're looking at the crime, the population growth, the migration trends. We're primarily looking for places that have stable or improving population, which typically leads to or follows job growth.
Yeah,
And then we are always looking for, with the types of properties that we invest in, properties that have great schools because we feel that places with great schools attract families. Those families will stay in those communities through the duration of their children's education. So you tend to get stickier tenants that want to stay longer. We primarily work in the rental housing space. So, but I would say the same things apply if I was in the for sale space. I want to be in places where people are moving, where, a household formation is strong, those sorts of things. And the availability of data now, you really can tell exactly what's happening in real time and take advantage of those trends. It's not a guarantee that just because we're in an area with good population growth that we're going to have a good investment, but it's a good tailwind. And you have to offset that with supply. So typically, what we find is the builders, everyone's looking at the same numbers. So we're all looking at the same numbers and say, hey, Florida, it's great in Florida because so many people are moving there. And then builders will build and they'll all build at the same time. And then all of a sudden we've got 10 times as many houses as we need. So we
right.
have to be cognizant of what everyone else, reflexivity, right? Like everyone else's behaviors affect what you should be doing. And so we're all part of this same like system. So you have to be careful about all of that. But, we're looking at demos, we're looking at supply. We're looking at population growth and changes like that. And then we're overlaying that with how friendly the area is to landlords and tenant relationships, how the state is involved in the housing sector in that area. So that typically means that we're right now investing in the Southeast as
Okay.
well as Texas. So kind of going from Texas through the Panhandle down to Florida, mostly from I-4, so sort of Disney World north through the Space Coast up through um, the basically all the way through to the Carolinas. And that would be our primary space, although I really do enjoy and think there's a lot to be said about the Midwest. I think that that's something that's typically overlooked. Even though it may not have the same level of migration trends or population growth, it has strong incomes and a great workforce and a diversified economic base. So, and it has the only fresh water in the United States that we may have in the next 50 years. So,
Oh, wow.
I think that's something, the Great Lakes are an asset that we undervalue that may become more valuable as the country changes over time.
Interesting.
Did that answer your question?
Oh, no,
That's kind of how we think
it
about it.
definitely
That's
did,
sort of
man.
like
So,
the beginning. There's more to it, but we start there.
oh, no,
Uh,
that no, definitely no. So I usually just call it a hype, right? When you invest in the place, you want to look at the hype. So you want to look at the home prices growth, right? You want to look at the income growth. You want to look at the population growth, and of course the employment growth as well, right? Make sure that the diversification of jobs is there. But to your point, man, the market has cycles, right? Just like the stock market has cycle, the housing market has cycle as well. And it's really important to pay attention to what market cycle that you're purchasing a property in, regardless of what type of property you're buying. And also the projection of what environment you're going to be looking to sell that asset in, and also the quality of buyers that will be available, potentially will be available as well.
mhm,
Great philosophy, man. So navigating, I want to talk about some navigating the current cycles. In recent years, interest rate and inflation was a thing. Now it's tariffs amongst other things, right? So if you're a developer, right, and you get in a lot of your supplies from different countries, right, tariff might be a concern for you. Um, are you seeing or having an impact or projecting an impact in real estate development in the coming months or years?
Yeah, so we find that, that's certainly a concern relative to new projects that we're doing, right? Where we
Right.
have large budgets, there's material costs. We are typically getting our supplies overseas, or if we're not getting them overseas directly, they're certainly coming from overseas
Right.
indirectly. So we will be subject to material costs going up over time. But we have some flexibility as to when we acquire these materials. Most of our business plans are multi-year, so we can delay certain projects to wait for some of the noise of the
Okay.
political environment to change. And then again, most of our book of business, most of the properties that we own, they're not. It's not that they're not susceptible to those challenges, but we just don't have as much capital improvements to make on those projects.
Right.
So we don't have to spend the money and therefore not be subject to it. So yes, maybe we have to replace an HVAC here or there, et cetera, on a regular schedule, but we don't have a huge amount of budget to allocate. So when we have new projects, that's where it's most concerning or most affecting us is if we have a double of material cost, that's going to affect our project cost by 10, 20%, which may eat up all our contingency. But that also assumes that we actually move forward with 100% of the materials at this exact time versus, linearly acquiring them over the next couple of years. So that's, we have a few different strategies that we can use to do that. We can also stockpile, stuff that's already here,
Yeah.
put them in containers. We can, there's a substitution, right, of materials. If we thought, hey, this is going to be this is going to be 30% cheaper, all of a sudden it became 30% more expensive. We can go back to the original plan, which would have been just to buy from North America, for instance,
That makes sense.
which again, I think is part of maybe perhaps the goal of some of these tariffs is to get people to substitute a good that maybe is from another country to somewhere that's maybe closer to home. So some impact there. Outside of tariffs, I would say that I was just talking to a broker yesterday, and he was telling me about kind of what the composition of buyers looks like today.
Gotcha.
I think that the market is starting to change.
Hmm.
There was a time in 21, 22 where you had the syndicators and a lot of the hot money were bidding prices up, doing deals at potentially unstable or unsustainable valuations. Those folks obviously are, or maybe not obviously, but are not necessarily big buyers in today's market. And the liquidity was very thin for quite a while. There wasn't a lot of buyers for property, and there weren't a lot of sellers either, right?
Right. Correct.
After 2022, in the last 24 to 36 months, it's been not a lot of buyers, not a lot of sellers, or at least maybe there are buyers and sellers, but they could not agree on price
Great.
of what the price should be. And so now what I'm seeing and what I'm hearing from the brokerage community is over the last 6 to 12 months, some of those folks that were big buyers in the 2015 to 2018 space are seeing opportunity and they're starting to come back.
Great.
And those are buyers that were in the business for 10, 15, 20 years, right? They weren't new to the game in 2015, but they had long-standing relationships with these bigger brokerage houses, and they just stopped buying as prices moved up in 2020 and 2021. And now they're starting to come back. They're starting to see value. They're starting to think maybe we're at peak cap rates and cap rates are going to start falling and we're seeing positive leverage. And so you're seeing the programmatic investors are in the market. They're always in the market by definition, buying or selling based on their fund mandates. Then you're starting to see these family offices and these longer term holders come back and provide liquidity into the market. And so it feels but at the same time, you're also still dealing with almost the first wave of distress from the 2021, 2022 debacle. So a lot of the, properties that need to have a reset of basis that's going to happen. Either it happened last year, this year, or next year. So that's sort of cresting and the new cycle is beginning. And I think we're probably, in the first third of the game here, which I
Right.
think is a great opportunity for people who are well capitalized, have, high conviction to go out and acquire property, even despite all of the, you know, noise that there is in the political environment, the economic environment, as long as you're in it for the long term and you're considering margin of safety, as I mentioned in the beginning.
Yeah, that's awesome, man. Which leads me to the next segment, which is, innovation, distress, and scaling opportunities, right? So you've done hundreds of millions in housing related transaction, with the focus on distress, turnaround deals. What is the biggest mistake investors make when chasing distressed assets, and how do you avoid them?
Yeah, so I think it's right there in the sentence that you said. You can't really chase distress deals.
Right.
You sort of let them hang themselves and let them bleed out, and then they are just there for the picking. So I think it's about developing relationships with those who are closest to those deals, whether that be lenders, possibly property managers, or even other sponsors who may be in a rough position. We found that a strategy that we're employing right now, that we've been trying to employ for the last 18 months, but we've been early, but it's now starting to come to fruition, is start having conversations with sponsors who did perhaps buy at a pretty high price and have debt that is too expensive and has too high of a basis, and come into those deals and replace those sponsors, bring in some fresh capital, renegotiate with the lenders. And so that's what we're starting to see. A lot of, I think, existing sponsors are realizing that rates are not going to go down significantly. They're not going to see a 20% increase in the value of their properties now,
Right.
basically right now, or over the next 12 months. And they're just ready to capitulate and move on from the project. And so, and that, that requires some tough conversations with those sponsors, with the debt holders. And so we're having those conversations right now across a number of different transactions in different areas with either the current sponsor or the lender, depending on how far along the process has gone,
Right.
and seeing how we can come into that opportunity. We're vertically integrated, so we have our own property management company, and so we can come in, we can take over the day-to-day operations. We have a discretionary fund, so we can bring in and write a check to deal with deferred maintenance, things that maybe the existing sponsor couldn't do because their debt restricted them from taking on additional draws. So then we could recover the asset operationally, take over the property, wipe out existing GP, maybe hopefully recover some of the LP dollars from the old transaction, and then also make the lender whole. So I don't think everyone comes out feeling great about how it goes, but we have to move on from those transactions into a better market environment. And I think that's part of what's happening right now.
Yeah, I think it'd be really cool if everyone had a crystal ball back in, in 2019, 2020, right? Because I think we had a lot of good operators, just maybe their long-term projection or midterm projection was not consistent with what really happened in 2021, 2022. So, to your point, these properties are, in a lot of cases, are really good properties in good markets with good fundamentals,
Mhm.
right? However, because of the increase in debt and the inability to refinance these property in a traditional sense, it makes it really challenging for the property to cash flow. And then additional to not having cash flow, they're not able to execute the business plan, which drag on the reserves, right? And when you start bleeding all the reserves, then you come to a point where it doesn't make sense to hold on to this property, and they find somebody who can provide new capital to revitalize that business plan. So it's a great idea. Now, so you mentioned that you fund, right? Which lead me to my next question, right? As a fund manager and tech-enabled operator, how do you think about buying versus building operation infrastructure to scale, and what role does prop tech play in your decisions?
Yeah, so I my business partner at Carbon Cody is really responsible and spearheaded our vertical integration, building on our property management division, our construction division, so that we could take over these assets. And we found that just by taking over assets, our properties from our third party managers to bringing them in house, within 6 months, we see a 20-30% lift in the property performance just because we control the incentive structure. We ensure that the right people on the right seats. We can be more proactive in hiring and renewals and doing just a number of different things that we want to be able to do. That we may not be able to do or influence through a third party who has slightly different incentives than we do,
Gotcha.
potentially, in some cases. So I think they do their best. They work as agents, and they have their own incentives. And so we I can't blame them for being what they are.
Right.
But we find that our first, foremost, most important thing is that we have to protect the money that we bring into the deals from our LPs. They're one of our primary customers, that
Right.
them and the tenants. And so it's really important that we do our very best to oversee and run those properties. And we feel like first party management, if that's a term, makes a lot of sense. And so to that end, there are several prop tech things, I guess, we're doing. I mean, we're using voice and text-based AI where it's appropriate. So that would look like primarily when there's off hours. So people are still more interested in talking to a person
Right.
if they can. But if we're not in the office, then they'd rather talk to a robot or text with a robot than to get no response at all.
That makes
So
sense.
speed to lead is always a critical component of every sales process. We think of sales is very important, right? You want to lease new units, you want to get better and better pricing, you want to provide an excellent customer experience along the way. And so if we can provide 24-hour customer service, whether that's, 8 hours a day with our people and then another 16 hours for folks using robots, then we'd love to do that. And it's very cost effective and very effective for us. So that's how we do that, is primarily through text and voice-based AI, either answering the phones, dispatching phone calls out using robots, or texting. And then the same with R&M. So maintenance requests, things like that. That's all digital. So as much as we can put, digital, reduce friction, allow for seamless communication and constant updates,
Yeah.
making sure our tenants and our residents are aware of what's happening at our community, when rent is due, when a repair is going to occur, those sorts of things. That's all very important. outside of that, it's still very much a physical business. So there's only so much that we can do. I guess eventually we'll have Android robots walking around doing landscaping and cleaning the pool and things like that. But for now, I'd say most of the AI prop tech execution is around the software and the leasing and the maintenance requests, that sort of thing.
No, I got you, man. And a lot of folks are becoming, to your point, a lot more used to, dealing with AI to get them to accomplish their thing. So
Mhm.
next segment I want to focus on, education and mentoring, and lifting up the next generation of entrepreneurs, especially real estate entrepreneurs. No, so you give away a ton of educational content, which is rare for someone. It's usually rare, right? However, it's actually one of the things I like about this real estate environment is that in some cases we become more competitors than we are competitors. So why is it so important to you? Or let me to understand why it's important to you, and what's your message to aspire real estate entrepreneurs looking into 2025 and beyond?
Yeah, thanks. So, we have through our private equity firm, we put out weekly blogs on a number of topics that affect the real estate business, as well as we have a weekly newsletter. I do a daily podcast. You mentioned one of them, which is the Deal Flow podcast.
Right,
That's a interview style like this one that we do weekly, but I also have a daily news podcast that I do that's a short 5 to 10 minutes every single day on commercial and residential news, among other executions that we try to provide value to our listenership or readership or whatever you want to call it.
yeah,
But again, most of that is focused on LPs that can write 50, 100, $1 million checks. That's, a very small segment of the population. And so we also have a community, free community called inside of school called the Dealmaker Fast Track, free community where we provide endless, well, maybe not endless, but a significant amount of resources to help people getting started, going from that zero to that first deal, and not necessarily by writing us a check, but by going out there, finding the deals, analyzing the deals, and profiting from those deals, whether that's through wholesaling, right, flipping contracts, or if it's flipping and fix and flipping, or if it's turning properties into rentals. My first property was a $25,000 single family home, row home in Philadelphia, using the BRRRR strategy. And
right,
even though, yes, now we're doing 25, $50 million transactions, I'm
right,
still using the BRRRR method. It's the same frameworks, it's the same concepts, just with another zero or another few zeros on it. And so I think that everyone has to start from the beginning. And so our goal with the community is to get people involved in real estate. It's definitely changed my life. It's allowed me and my family to have the life that we want. We live in Boulder, Colorado. Get to enjoy the outdoors and talk to you, which
yeah,
is great. And so I would encourage anyone who is just getting started or just wants to learn more about real estate to go out there and educate yourself, whether it's in our community or somewhere else. It doesn't much matter. The information is out there. Knowledge is not the barrier anymore.
it's not
Even if you just wanted to use ChatGPT, you could get all basically the same information out of ChatGPT as you could get in my community. It may be that we organize it. Hopefully, I hope we organize it in a way that's impactful for people.
right.
But something I say, we run a live workshop every other week, and this is actually our last day. I have to after this, I'm going to go do day 5 of our workshop. But I say knowledge without action is useless. Goals without action are wishes.
Yep.
So you really have to think about, it's not the knowledge that's the gap anymore in today's society with all of that's available. It's you have to take that knowledge, you have to get out of learning mode at some point and go out there and, swing a hammer or,
Yep.
buy something or, have a conversation with a person. And that's where business happens. That's how real estate happens. It doesn't happen in a workshop necessarily or in a digital community. You have to maybe start there for a little bit, but you got to get out of those communities eventually and go take action. So that's what our message inside of our community is: go out there and take action. And most of what you'll learn is going to be from doing that.
That is awesome, man. Now, here's the thing. And the same conversation towards sharing knowledge, right? So you've spoken to brokers, sponsors, prop tech leaders on the Deal Flow podcast. Can you tell us, briefly about one conversation that completely reshaped the way you think about real estate?
Well, completely.
Maybe not
That's a big
completely,
order.
but
Okay, not completely. Okay,
improved,
so
maybe.
I spoke with the guy early on. So just last week I was talking to this one of the students, and they wanted to start doing land flipping. And I've
Okay.
got some friends who are in the land business, and I did a podcast with a guy based out of Florida earlier this year
Right.
that is doing this at scale. And I just listening to him, it's just interesting to see that there's so many opportunities out there to create any size business in real estate that suits you. And I think that was something that was interesting to me is just, whether you're just starting out or this particular gentleman was, had 3,000 units of development going at the same time. And over all these different projects, he was doing these land deals where he would put them under option and then he'd find a builder and he would take his equity and roll it into the deal. And he was just doing it at a very high level and, big projects, 50, $100 million each. And he was able to do, a lot of these projects at the same time because he wasn't actually doing any of the physical construction. He was sort of just like putting the deals together and kind of putting the different pieces together, the engineers and the surveyors, and then the sponsors and the equity, and then just getting a little piece of the deal by
Wow.
putting it all together. And I thought it was just really great because he was such a deal maker himself,
Hmm.
and but he'd been working at it for 15 years, right? He didn't in a year or in a month get there doing it at that scale. So I think it's just, with real estate or really any business, you can create something out of thin air based on what suits you. And it's going to take you a while to get to maybe your ideal state to wherever you want to go.
Right.
But just know that just keep on working at it, and you can carve out whatever niche is appropriate for you that you want, as long as you just keep taking action and you just keep getting up, because you're going to get knocked over quite a bit, but that's all part of the process.
Yeah, man. Don't quit and don't die.
Don't quit. Yeah, you can only lose if you stop.
No, 100%, man. So, you know, that leads us to getting towards the end of this podcast. And before we get into the focus round, I've got two more questions I want to ask you, man. And it's about real estate in today's, right? So the contrarian play, right? What is one real estate strategy or niche that you think a lot of people are not paying attention to that it has massive potential over the next 12 to 18 months?
Yes. So it's almost like like we did not plan these questions.
We
In
did not.
fact, I had said that I don't want to know what the questions are in advance, but because I just like to say whatever I think at the moment.
Right,
And so for this particular, we recently did an article, I think earlier this year, I can't remember exactly the date, talking about the perception vintage
okay,
plays in housing. And so right now we're seeing a lot of folks move away from 60s, 70s, and 80s vintage properties
right, yep,
and move into 90s, 2000s, and 2010s because they're looking at those and they're saying, well, they're getting older. There's a lot of sponsors got burned because they didn't think about the plumbing and the electrical and the roofing issues that you can encounter in those older properties. And so, as someone who's done thousands and thousands of units in that vintage, I think that now is actually a fantastic opportunity to take advantage of what I see as a big discount for that
okay,
perception risk. So it's not an actual risk. You're paying a lot more right now to buy newer property on a price per square foot basis, on a revenue basis, on the perception that newer is better. And I don't necessarily know that that's the case, especially if you do a great job on your due diligence. You ensure that that plumbing is in good shape, that electrical's been upgraded, and your product is in a good position because those properties still have to house the workforce housing of America, right? The
mhm,
people are not, a lot of people are not able to afford $2,000, $1,800 rents. You need to have a product out there that provides 800 to $1,400 product, and that product is the 70s and 80s vintage. So right now we're finding opportunities where we can buy those properties at the same prices as we could in the middle 2010s,
mm,
price per square foot, but incomes are 50% higher, revenue is 50% higher. And so we're finding a lot of opportunities there. We're able to get a really great cash yield out of those properties, and we don't have to compete with all of these other folks that are all sort of on the same bandwagon of, hey, I want to go up vintage. So I think there's a strong opportunity now as the market shifts, as we get to a hotter phase of the market. that perception discount gets eliminated and people don't care as much about vintage.
Right.
When the money gets really hot, we did a kind of a study on this and we found that a lot of that perception discount goes away when the market gets really hot, like 2021. And
Mhm.
so during those times, that's when you actually want to go to the newer vintage because you're not paying up for that vintage relative to the older vintage. But when the market is cooler, like it is today, there's a significant discount that's not explained by expenses, NOI, revenue, or any other financial metric. It's completely based on the perception and the flow of funds and the herd mentality. And so we're looking to, try to go against that. And that's what we're doing now.
Now, that is a unique perspective, man, because myself as a syndicator, we're focused on buying newer properties as well. But I
Yep.
definitely see your point as far as older vintage properties, right? Plus, also, in today's environment, there's so many new properties coming online, right? That in some cases it makes more sense to buy those property. Reason being is that you're dealing with less operational risk, and it's a lot easier to manage because you're not dealing with all the upgrades and upkeep, right?
Mhm.
So for the new vintage. But however, when you look at a value-based investment, some of those older vintage property is definitely a good play.
So one more point I would say is like I think that there's a reasonable barbell strategy where you can look for those attractive newer opportunities,
Right.
especially the ones where you had sponsors who made new developments, they're busted now, and you can buy them at a really good price relative to the replacement cost.
Hmm.
So I'm not suggesting that those properties aren't a good buy, but I think people should just be aware that there's a discount you can capture for older property that is not apparent in the market. And what we look for when I think about margin of safety is we look less on the going in cap rate because what a lot of people will say is, well, the going in cap rate for both of these sets of properties are basically the same.
Right.
I can get a six cap to a six and a half cap for a 70s vintage as I can for a 2010 vintage. Well, why would I buy an older property the same cap rate as a newer property? And I think the answer that we come out to is I can get that 70s vintage up to an eight cap
Hmm.
through a value add, whereas the newer property, I may only be able to trend that up to a six and a half to a 675 or maybe a seven.
Right.
And so for us, we look at, okay, what is that yield on
Unit
cost in
cost. Yeah.
year four, year five, and how do I feel about that basis? Right? Because that 70s vintage property, I might be at an eight cap and only be at $120,000 a door in 4 or 5 years all in. That newer property, you may only get up to a six and a half, maybe a seven cap, and be at 250 to 300 a door all in. And then I may be competing with new construction
Yeah.
or, maybe more difficult to cover my expenses or see revenue growth. So that's what I look at is, hey, if I could be at 40 cents on the dollar relative to replacement cost, be at an eight cap, which should be significantly above the market cap rate and the financing rate. I feel pretty secure and I'm also a long-term holder. I'm also looking to like, if I can, never sell. So
Right.
I also just never want to sell. And so I'm only selling if my investors are essentially requiring it. So yeah, so that would be the one other point I would make about that.
Man, to your point, we didn't plan this podcast, but my next question is actually about, fund strategy, right? So how do you think
Okay.
about aligning investors' incentive inside your fund structure, especially with LPs looking for income and growth?
Yeah, so income, we are right now and are always looking at cash flow. Cash flow is king. We and most of the deals that we're doing today either are loan assumptions where we're having really strong yield going in,
Right.
or they're going to be turnaround strategies where we're taking over deals, like I had mentioned before. Those deals, not a lot of cash flow to start, right? We're
Gotcha.
we're coming into a deal with low occupancy. We typically have to make some sort of operational improvement, but we're going to get to what we think is a much higher double-digit cash on cash by year three or year two, even. For the deals that are more stable, where we're taking an assumption on, or even new debt, we're looking at for new debt, we're probably looking at that 5% yield right out of the gate. And then when we're taking on an assumption right now, we're typically seeing almost double digit cash on cash yields right into the deal, or certainly by the end of year one. That's how we're thinking about yield in today's environment. And we're doing that through agency, fixed rate debt, long term, 5 to 7 year money. primarily with the expectation that we're going to refinance that at that end of that term and continue to hold that asset.
Hmm.
So far as growth, again, we feel like we're buying at really good basis in today's market, wherever we are on the vintage curve, whether it's an older asset or a new asset. We feel like, 5 years forward, we're going to be really happy about the prices we're paying for properties in today's market relative to a few years ago or even 10 years ago. So that is how we're thinking about margin of safety and growth is really, hey, we think we're getting a great value today from a price per door perspective. We're getting paid to carry the asset on a yearly basis through positive cash flow. And then so far as hold period, we are long-term holders. We tell our investors we underwrite and show a 10-year model in our
Okay.
underwriting. So we don't show a 5-year model in our pitch decks or our materials. We're showing a 10-year model. And what we'll tell investors is that, when we get to the end of our first maturity, right, whatever piece of debt that looks like, we're going to assess the market. If we feel like we can get a really strong exit at that point, we will, look at that. We'll talk to investors. We'll see what their interests are, and we will, no matter what, likely 1031 that into the next opportunity or recapitalize that deal with new investors who want to stay in. So, from my perspective, a property I own, I know a lot more about than a new property I'm going to buy. So if I know I'm in an asset that I like, then I'd rather hold that asset for the long term. And if the investors want liquidity, we can provide that liquidity without losing control of the asset. So I see the asset and the equity as two separate things, and
Gotcha.
I can hold the asset while still providing liquidity to the investors through a refinancing or they can get taken out of that deal and put it into another deal, and we can bring new investors into that first opportunity with the recapitalization. So there's a lot of things we can do inside of the capital structure without necessarily losing control of the asset.
Man, that's phenomenal, man. You have multiple exit strategy, which is really good for investors. Now, man, I want to be mindful of your time. We got a couple more minutes here before we have to go prep for your live event. And
Mhm.
I want that just dive into the focus round, which is just focus acronym.
Okay.
What do you do for fun when you're not managing capital and recording podcasts?
Or running live workshops or doing coaching calls. I would
Yeah.
say I every morning I go for a walk for about 2 hours before my family wakes up, and I live in Boulder, Colorado, right next to the foothills, so I get a great view. And these last couple of weeks, there's been like a herd of deer that have
Nice.
been grazing right near my house. And so every day I get to see them, doing their thing, and I get to walk by before the sun comes up. So I would say that's exercise, hiking, that sort of thing, getting outside, getting away from my computer and all of these things that are buzzing around me.
Man, that is cool. I just returned from Australia and they had kangaroos over there
Yeah.
walking around like deers. I thought it was weird. I thought I had to go
Yeah.
to the
Yeah.
zoo to see
You got to be
kangaroos.
careful, right? You got to be careful. One of them might punch you in the face or whatever, right? Or
Yeah, I
kick
know.
kick you in the face. Yeah.
So we went close to take some pictures, but they were actually
Yeah.
more scared of us than they trying to fight. So,
Okay. All right.
uh,
There you go.
opportunities, man. What was one career defining opportunity that changed your trajectory?
It's always really hard to connect the dots on the, going, forward, right? You only really see them on the way back.
Right?
So I met my wife senior year of college, and my intention prior to meeting her was I was going to go to Southeast Asia and teach English and travel, and backpack throughout,
Right?
Europe or whatever. And that probably would have taken me off of the path that I was on, which was ultimately landed me at JP Morgan and then, into consulting and then into real estate. It's sort of like the butterfly effect. And I was, I met my wife on a birthday party that was a friend of a friend. I was almost not going to go. And so the fact that I managed to get off the couch that night to go to that party, meet my future wife, and then progress through the next 15 years. I think that was probably the most defining point of my life was meeting my wife and going to that party and that one thing changing. I probably would be in a totally different place. I
Man,
don't know if that was business related, but
no,
it was
that's awesome
defining.
because
Yeah,
it set the foundation for almost everything else. And
yeah.
to us having this conversation at this
Yeah.
point about some
And
amazing
we're
things.
happily married now, and we're three kids in, fourth on the way,
Ooh,
coming
good
here
job.
in July. So we're busy, busy.
Man, congratulations, man.
Thank
So
you.
we got three more questions for the focus round. We got what, 2 minutes to do it? Less than 2 minutes.
Okay. All right.
So communication. What's your number one rule when communicating complex deal to investors?
Yeah, we have a one pager and we have a pitch deck.
Okay.
And we try to come up with the 3 to 5 most important things that we feel like are going to resonate with investors, and we put those front and center.
Keep it simple. All right. What is one thing you wish more passive investors understood before placing capital?
Real estate is a long game, and
Mhm.
you should not expect to double your money every 2 or 3 years.
Last one. To what do you attribute your success?
I think getting up every day and doing the work.
Man, that's freaking awesome, man. Michael, it's been a phenomenal pleasure, man. How can our listeners, if our listeners want to get into your ecosystem, what is the best way for them to get in touch with you?
Sure. So you can, if you're an LP or you're someone who wants to get on our newsletter, I recommend you go to investwithcarbon.com. And if you're not quite there, but you want to learn how to do it yourself, I recommend you go to school.com. That's SKOOL.com. And then look up the Dealmaker Fast Track, and you'll find our community. We just passed through 2,000 members. We started this community in January. So we've seen some pretty tremendous growth in the last 90 days, and we're shooting to get to 10,000 by the end of
Oh,
June.
wow.
So hopefully some of your listeners can be part of that journey, and it's completely free. And I do calls every single day in there. So if you want to talk to me, you can get me right there for free.
Man, that is awesome, man. Michael, thank you so much for sharing your journey from your, job site, private equity, and all the insights in between. You've shown that innovation, legacy, and education can and should exist in the same ecosystem. For the listeners, I want to thank you again for listening to another episode of the Multifamily Real Estate Experiment podcast. And if you found value in today's episode, feel free to leave us a, 5-star ratings and a good review, right? Until next time, keep owning more of America. And this is Hutch the Marine Investor out.